Welcome to Opal TV. Today I'm in Stockholm together with Mikael Stenbom. He's the founder of RPM. Mikael, please tell me a bit of your history and how you set up RPM.
I was an officer in the Swedish Navy, and I'm a graduate also from the Stockholm School of Economics. And a year or so after graduation, I ended up at the OM, which later became OMX, part of NASDAQ OMX. That's where I learned about derivatives, and options and futures. I left OM in about 1989 something and became a management consultant. And as a management consultant, I was introduced to a company called the Nordic Commodity Brokers that had partially the same owners as OMX. And the owners asked me to basically tell them why they owned this company and provide them with a development plan, which I did as a consultant. And a couple of years later, I was hired as the CEO for that particular company. Now we are in the early 90s, and we had a financial crisis here in Scandinavia. Things were pretty bad. The banks were saved by the government, successfully so, I might say. And this created an opportunity for myself and my partners to do a management buyout of the part of this company that we were interested in. And that was the money management part, or the managed futures CTA part of the business. Initially, in our early years, we had our clients here in Sweden. And we worked with Swedbank, we worked with a local investment bank called Alfred Berg. We decided to try and make a name for ourselves internationally. Now we're talking in 95, 96. And we quickly had a success actually in Switzerland and later in Japan, and also Germany. But Japan remained for many, many years our largest single market in terms of nations. So today we are active, we have clients all over continental Europe. In Japan, we also are active in Sweden, of course, and we are right now, this very moment, entering the United States.
So you founded RPM in '93, and obviously you have grown a lot since then. Tell me more about where are you now and what are the different lines of your business?
I think that today we are widely recognized as a CTA specialists. And as a CTA specialist, we have, broadly speaking, two lines of business. The first one, and the original one, is one where we build multi-manager portfolios and investment vehicles for larger investors. That could be institutions, pension funds, and also banks, investment banks, or other larger distributors. The second line of business that we pursue is one of risk management or risk monitoring, where we offer third parties. Again, it could be larger banks or institutions, but in some cases also managers or CTAs. We offer them risk management services. We act as a third-party risk manager or risk monitor for their own internal use, or we disseminate our reports and analysis to their investors. So all in all, we manage or advise about, today I believe, $3.5 billion.
Tell me more about CTAs and why are they important, or how can they help improve an investor's portfolio?
CTAs are a rather unique breed of asset managers, since they are, for the most part, they are systematic or at least very disciplined. It means that they typically do not have a personal opinion on whether the gold is high or low, or the dollar should go up or down. They are responsive. They simply respond to what markets and prices tell them. And given the fact that they are systematic or algorithmic, as some people would say, they are in a unique position to profit from inefficiencies in the marketplace. So, as Professor Lowe at MIT puts it, markets are for the most part efficient, but sometimes they become very inefficient. And those times are typically when we experience some kind of crisis, some kind of financial meltdown or close to, and which is typically driven by the equity markets. So if you look at CTAs, you will notice that their performance is at its best. Equity markets tumble when equity markets go into real bear markets, like in 2008 and in the early 2000s and 87 and 98 and etc., etc. And the reason for this is that markets during those periods become very inefficient. Fear, greed, institutional restrictions, behavioral biases all come into play in such scenarios. CTAs, being active in the most liquid of all marketplaces, the futures markets, can simply respond to whatever the markets are telling them and exploit the inefficiencies that occur. In more concrete terms, they can exploit price trends that arise from panic or distress in the markets. And that is this particular feature with CTAs that is perhaps the most attractive. We call it crisis alpha because it's an alpha that is very unique for this type of managers. Now people might ask, what do they do between the crises? Right? Well, typically most CTAs make money when there are price trends. And price trends are sustained price moves in enough markets to compensate for small losses that they suffer in non-trending markets. And this alpha that they create, or the return that they create between these crisis periods, can be viewed as a standard efficient market hypothesis risk premium for providing liquidity and hedging opportunities for other players. Institutional investors typically invest with CTAs precisely for this crisis alpha characteristic in the CTA world. The protection that have occurred and most likely will occur in the future in times of equity distress. And we saw the whole industry experienced a rather significant inflow of capital in the aftermath of 2008. We noticed, or investors noticed, that CTAs had a stellar performance in 2008 when equity markets went down. And this induced many institutions to invest or include CTAs and managed futures in their portfolios. To be a little controversial, they tended to take the easy route. So they simply invested with the largest and most well-known managers. And that was perhaps not the wisest decision from a strict risk-return perspective, because a manager's performance is over time very much linked to both assets under management and age. Increasing age and increasing assets under management are not positives, they are negatives for future performance.
Now, how do you deal with that fact? What do you do about it, in other words?
Well, we believe that we have found a stringent method, or methodology to be more precise, that assist us in identifying the what we could call the sweet spot for a manager. We have been inspired by the classical corporate life cycle, with a company has a startup phase, it has a growth phase, a maturity phase, and then a declining phase, possibly a rejuvenation phase. I think Apple is the standard example of startup, growth, maturity, decline, and possible rejuvenation. What we have found, and we are not alone in these findings, there are lots of academic research coming to the same conclusions, is that this general pattern of startup, growth, maturity, decline, and possible rejuvenation is perfectly true for asset managers, as for any other company. Now, the problems with these phases are that, in the startup phase, they may give very high returns, but there are lots of operational risks. In the growth phase, they are still small and still unknown, and they have perhaps a short track record and relatively small assets. In the maturity phase, they have proven themselves to be very talented traders. They have typically a long track record. They have large assets under management, and that is when investors are attracted to them. But then, after a certain asset size and or a certain age, their competitiveness in terms of risk-adjusted return, tends to deteriorate. And most of the managers simply gradually over time fade away, while some have the creativity, the energy, the will, and the intellectual sort of capital to rejuvenate themselves. And if you think about it and look at the CTA industry, today's big names are not the same big names that were active 10 years ago. And the big names 10 years ago were not the same yet another 10 years ago. So it's a dynamic universe that evolves over time. What we've done now is we have tried to, for each group of sub-strategy within the CTA world, we have defined limits on assets and age, both on the low side and on the high side, to try to identify the sweet spot, the growth phase, where the manager still is young, energetic, creative, innovative, but yet has been tested in the marketplace and have built an infrastructure, reduced all the operational risk enough for a professional investor. And simply put, we simply define a pool of managers, a dynamic pool of managers that conform to these criteria. And we perform our due diligence on those managers and those managers only for a particular fund. And the ambition is, of course, to invest very early in what will become the next generation of big names in the industry. Now, this is not really new to us because we were very early investors in many of today's big names. All right? But what we do today and what we have developed over the years now is a more disciplined, a more rigorous approach to it. Earlier we were more intuitive, we relied on our experience. Now we also have a systematic toolbox or a rigorous toolbox in order to define the sweet spot.
For investors, what is important to look at when investing into CTAs?
In every disclosure document and in every marketing material that is published by a CTA, there is a statement on virtually every page that says, past performance is not necessarily indicative of future return. We see that phrase so often that we have become desensitized to it. Right? We have seen it too much. We don't pay attention to it. The truth is that that statement is very true. Past performance is not indicative of future return. And that should be repeated ad infinitum. And the most common mistake that people do when investing with CTAs and with hedge funds is that they look at past performance and expect that that will be repeated. If they're lucky, but only if they're lucky, it will be repeated. But for the most part, it will not. And that is the first lesson. I say it again, past performance is not indicative of future return. And we have 20 years of experience from this business. It is true. Now, once that we put away that issue, what is important? Well, it is very important for an investor, or at least an investor, an institutional investor, or an investor of our sort, to really understand the investment logic. The manager, the CTA, has to be able to answer the question, why are you making money? And why should you be making money? What is the reason? If the CTA cannot answer that question, there is a certain risk, or perhaps a big risk, that the CTA's reasonably good past performance is simply luck. But if he can answer that question and give you a reasonable understanding of the logic of the idea, you may be able to correlate the CTA's performance, future performance, with the behavior of markets. And that way understand whether the manager is actually doing what he's supposed to do, if he's lucky, or if he's skillful, or what is the reason behind his current performance. And that is the first step of risk management. Be able to correlate the CTA's performance with market behavior. Now, this is not an easy task, and that is why people like us exist. And there's a lot of number crunching, and there's a lot of experience that need to be done, or you need to have, in order to perform this first step of risk management. After that, of course, there is a lot of other, number crunching, VAR measures, drawdown measures, and various type of ratios. But, they are basically only, different expressions of the same thing. How does the CTA interact with the market, with his system, or with his trading logic? And that is where everything starts.
So you have been involved in the CTA industry for over 20 years now. Over this period, how did you see the CTA industry change? How has it evolved?
I guess you can look at the development of the CTA industry from quite a few different perspectives. One is, of course, the assets that are managed by CTAs that have, of course, grown enormously over the years. And today, some people say it's the single largest alternative investment strategy in terms of assets under management. I don't know if that is true, but it's certainly one of the largest. From being a more obscure, weird strategy 20 years ago. Another perspective is, of course, the development of CTA and the way that they approach their respective task. When we started in this industry in the early 90s, most CTAs were American, US-based, and most of them were turtles, or they were turtle disciples, or very, very similar. And there was one mantra that they all had, and that was, I never touch the system, meaning that they had developed an algorithm or a series of algorithms that were designed to capture trends, and as long as there were trends, they would make money. And the worst thing you could ever do was to start tampering with the system in a drawdown. Now we move in the late 90s, and we see another breed of traders coming up. that are sort of replacing the turtles gradually. And those are the more intellectual, the more research-driven, academic European-style traders. Winton, Aspect, AHL, similar traders that quickly gained a position as the industry leaders, and sort of for quite a number of years they were actually on the top of the charts. And the American old-style turtle-like trend followers were, distanced by quite a lot by this new breed of traders. Now we are perhaps in the beginning of a new development where we see another type of traders that are even more technology oriented, that are evolving in this space. It remains to be seen whether they will pick up and be the next generation's leaders. But that will certainly be an interesting development.
Tell me more about the new breed of traders that you have been describing just now.
I think they perhaps differ a little bit in perspective. A number of the new firms that are successful, they aren't really, their background is not in markets. They are tech guys. Their background are in computers. They are more general. They've been studying physics and computer technology, and they apply a more general knowledge, general skill set on markets. They could equally well apply that knowledge on forecasting the weather or anything. The background is not in markets. Perhaps their potential advantage is that they have they're more open-minded. They are not stuck in any preset notion about how markets should function or should not function. But again, it remains to be seen whether it's difficult really to define this new breed of traders in a more rigorous way. But I have a sense that there is something new boiling with a new type of managers coming up.
Are you working on any new products at the moment?
Yes, we have actually, after a 3-year research effort, we have now recently launched a fund that is focused only on these evolving CTAs, these smaller and modern innovative CTAs that we talked about earlier. And that fund was launched here in Europe. First trade was actually made in the 1st of March. And we added 2 new share classes, a Euro share class and a Swedish crown share class in June. And we are now offering that particularly to a European audience. There will be a Dutch feeder fund that will open up towards the end of September for Dutch investors into the Evolving Fund. And I'm quite happy to say that the fund has done, in absolute terms, okay. We're up on the year. I think the last number was up 3%. But in relative terms, relative to the CTA industry as a whole, it's done excellent, with an overperformance of 6% since 1st of March.
What can investors expect from your new product, where you are focusing specifically on the evolving managers?
Our research tells us that the evolving managers as a dynamic universe, the managers that conform to these age and assets under management criteria, this universe of managers have over the last 20 years outperformed their larger peers, the larger managers, with about 3% per annum at an equal volatility or equal risk. That is what is our target, to achieve at least 3% above whatever a large manager index like BTOP 50 delivers. We have now been active, or the fund has been up and running with the Evolving CTA concept for about 6 months. And currently the overperformance is 6%. Now, will that last? Nobody knows. We believe that we have defined a better universe, sub-universe of managers, and from which we can pick our managers and perform our due diligence on, and also perform our active management on. But I think that is we should be able to have an overperformance of at least 3% per annum.